There's a quiet trap in Huntsville's housing market. The listing price that looks like a deal and turns out to be a demolition project in disguise. Verena Johnson has been writing about it, and the receipts are not pretty.
This episode covers two connected ideas: how to evaluate what a home actually costs beyond the sticker price, and how low down payment financing programs can make ownership reachable for buyers who thought they had to wait. Let's start with the case against the cheapest house on the block.
The central tension here is one buyers feel immediately. A lower listing price looks like financial wisdom. The Post asks whether that instinct holds up once you look past the number on the sign.
The Post frames it directly. The cheapest house can sometimes become the most expensive purchase a family ever makes once hidden repairs, financing issues, taxes, insurance, maintenance, and long-term ownership expenses begin to accumulate.
That list isn't abstract. Foundations, roofs, HVAC systems, each one can run tens of thousands of dollars, and none of them announce themselves during a 30-minute showing.
Right, and the Post adds a financing wrinkle that catches buyers off guard. FHA loans require homes to meet minimum property standards at appraisal, so a discounted property needing significant repairs may not qualify for financing until that work is completed first. USDA zero-down programs carry similar property requirements.
So the bargain house can block the loan program you were counting on. That's the kind of surprise that turns a deal into a delay.
The Post also flags cosmetic upgrades as a specific hazard. Fresh paint cannot repair foundation movement. New flooring cannot eliminate moisture intrusion. The point being that surface improvements can mask structural problems a buyer needs to find before closing, not after.
Which is exactly why the Post keeps returning to the inspector and the agent as the two people standing between a buyer and a very expensive lesson.
Location factors in too. The least expensive home may sit near industrial development or flood-prone areas, and those conditions affect long-term appreciation even if they don't affect day-one livability. That neighborhood context connects directly to the financing side of this story.
The follow-up question is obvious. If careful evaluation matters this much, how do buyers who haven't saved a large down payment even get started?
The Post on zero-down opportunities puts it plainly. Many buyers in 2026 are becoming homeowners by taking advantage of government-backed loan programs, down payment assistance opportunities, and financing solutions designed for qualified borrowers.
So the savings barrier is real, but not absolute. VA loans, USDA loans for eligible suburban communities, state and local assistance grants, the programs exist, and the Post is clear that many families have more options than they assumed.
The Post is equally clear that zero down does not mean zero scrutiny. Lenders still evaluate income stability, credit history, and debt-to-income ratios carefully. The Post recommends starting the financial preparation process months before actively shopping, so there's time to strengthen qualifications.
The Discover Zero Down Payment Opportunities piece also makes a point worth sitting with. Buyers who get pre-approved and organize their documents early are more competitive when a desirable home appears. Preparation isn't just about qualifying, it's about being able to move.
And Huntsville's continued growth in aerospace, defense, and technology keeps demand steady, which makes that preparation advantage meaningful in practice. The market isn't waiting.
The through line across both of these is that the number on the listing sheet is almost never the whole story. Not on cost and not on access.
Exactly. Understanding what a home will actually cost you and what programs might help you get there changes the whole calculation. More on what that looks like on the ground next time.